I'm going to have a quick conversation about valuation. Got a number of entrepreneurs that I talked to in the last couple months where their valuation is way up here. And I got to tell you, most of the time the investors are going to be right down here. A lot of gap between those two. You have to be in the same ballpark if you want to get money from an investor. So let's take a look at it as a baseball player. If you're Mike Trout, he's been in the league for over 5 years, and he's batting around 300 a year, 40 home runs a year. He is going to command a very lofty salary, like 30 to 40 million a year. If you're a rookie, and that's what an entrepreneur is, they're not going to put a big risk on you because they'd like to see what you can do. Look, you're just not going to get that big of a valuation just yet. You have to perform on the big stage, the big show, before you get that big contract. So if you don't believe me, I want you to look at this chart that I'm bringing up. It's from Jason Calacanis. He's an author. He invested. He's an angel investor. He's invested in over 150 investments. So let's take a look at this.
So this is the graph I'm talking about. This is the valuation versus traction matrix created by Jason Calacanis. Like I said, he's the guy that invested in over 150 startups in Silicon Valley area. And you can see right here on the y-axis, 12 million is the most he'll invest in. Like 12 million valuation in a startup. Remember, he invested 25,000 in Uber when it was worth $5 million. On the y-axis, you got idea, mock-up. MVP is minimum viable product. Unpaid pilots, you're testing it. Somebody's got it in their business and they're trying it out to see if they like it, see if it saves them money, etc., or makes money. Paid pilots and revenue. The green line is the path of the usual average startup. You're going to get a higher valuation if you're in this quadrant. You're going to get a lower valuation if you're in this quadrant. This quadrant right here is the riskiest because it's just an idea, mock-up, NP. The likelihood of investor ever getting a return is probably 1 in 1 million. If you're over here and you've done a Y Combinator, Silicon Valley startup, you're in the syndicate, an angel network, you've increased your chances of succeeding. What I am trying to show you here is we got to be realistic about your valuation. If Jason Calacanis has done over 150 investments, anywhere from 25,000 to a couple $1 million, and he's built a 150 million fortune, he knows, he's got a really good idea of what these companies are worth and what the likelihood of them is to succeed. So if you can get yours down to $12 million in between that range, you're going to increase your chances. You're going to increase your chances of getting a friends and family round. You're going to increase your chances of getting a angel and seed round. And then even possibly, if your business idea takes off, you could even start talking to VCs. They want you to go big or go home. But we got to be realistic about what your idea is worth and value. Only worth what somebody's willing to invest or put money up for.
So let's not be worried about valuation being too high right now. You want traction, you want customers, you want to build an enterprise. Why am I saying that? Because Facebook was valued at $5 million. Peter Thiel invested $500,000 at a $5 million valuation. He's worth over $1 billion because of that. Jason Calacanis invested $25,000 into Uber, and he is worth $100 million because of that. Uber had a $5 million valuation. So let's not worry about that. If you like this, like, comment, or share, or reach out to me at pitchdecksecrets.com. Thanks again, John Stoddard.